From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, U.S. Treasury yields tumbling from multi-year highs, prompting traders to pare back their rate hiking bets, receiving impetus after a disappointing core CPI report. We begin with the big issue, the Fed under pressure.
The Fed has to get inflation under control.
The question is, what are we willing to do?
Inflation is a problem.
The CPI number.
This is a tricky game.
The messaging has been incredibly hawkish.
When you look at what's happening in the bond market,
You've had a huge sell-off in the bond market.
Demand for bonds is evaporating quickly.
This job of orchestrating a soft landing.
The ever-elusive soft landing.
It's going to, I think, require some fancy footwork from the Fed.
But to me, the messaging is clear.
They need to normalize as quickly as possible.
can the Fed slow the economy, cool the economy, have a soft landing without creating a recession?
That's the question, and it's a very good one.
Joining us now, Societe Generale's Subadra Rajappa, PGIM's Michael Collins, and Morgan Stanley's Brian Weinstein. I gotta say, today's move really highlights the peak hawkishness that some people were talking about. Subadra, do you think that what we're seeing with the decline in yields from multi-year highs is signs that we did reach peak hawkishness?
It certainly feels that way because the market was very efficiently priced for rate hikes for this year as well as next year, getting the Fed funds rate to 3% by the middle of next year. That to me, especially in the context of a very aggressive path of runoffs from the SOMA portfolio, seemed like it was quite aggressive, market pricing of rate hikes. So I'm not surprised that you're seeing a little bit of a pare back. I mean, I think the CPI number was an excuse. We did see a very high print. We got very, PPI as well was very high. But we were kind of looking for some nuances to be able to pare back the very hawkish market pricing because I felt like the market had gotten a little ahead of itself.
Michael, is that how you interpret this random sigh of relief after what seemed like, in many ways, very hot CPI and PPI prints?
Yeah, Lisa, this is pretty typical. You get to a Fed hiking cycle, and once the markets are pricing in a lot of hikes, you do tend to see a peak in the overall level of interest rates. And, but it's not that big of a move, right? The markets were pricing in a terminal funds rate, meaning in a year or a year and a half from now of just over 3. And now they're pricing in one of just under 3. Personally, I would still take the under. They're going to hike until something breaks. That is their MO, or until they get inflation down, and they both may happen at the same time. But, I'll still take the under on the Fed being able to get all the way up to 3%.
All right. So, Brian, from your perspective, do you think that this is basically what people are coming to the realization of, that, frankly, something will break sooner than some people had previously thought?
Well, I think there's another question, Lisa, which is the raising the Fed funds rate as much as you can the best way to fight headline inflation, right? So we saw some aspects of core soften a little bit, but we're seeing food and energy prices continue to stay high. I think forcing the issue and just trying to break something is not what the Fed is going to do. They have two tools, right? The Fed funds rate, and they have the balance sheet. I think the market just realizes they don't need to do as much in the front end if they're going to sell securities as well.
But, Brian, what happened this week to really underscore that? Because, for example, let's talk CPI. If you look at a lot of the main components, including rent, including a lot of the major issues that people are focused on, they're all sky high. Yes, you saw auto prices come down. Is that really enough to give you confidence that we are seeing peak inflation in a lot of the massive categories for consumers?
No, I don't think it's enough. And I think that, I think the Fed rhetoric has changed in the last 6 weeks dramatically, right? At first, it was the Fed funds rate is the primary tool, and a lot more focus recently on the balance sheet. So I think what I think Michael said before, that we priced in as much as we could for a little while. This is pretty standard. You priced it in, you pull it back. But I think the problem is still the same. The Fed they have to stop the psychology of inflation from getting more ingrained. It's very difficult to do when, as you say, everything seems to be getting more expensive every day, and they're still way too easy.
There was a quote, St. Louis Fed President Jim Bullard really came out and highlighted the pressure right now, saying there's a bit of fantasy in current central bank policy. Neutral is not putting downward pressure on inflation. It's just ceasing to put upward pressure on inflation. Michael, how do you get the sense that really you were seeing any response whatsoever to even the perceived tightening of Fed policy that gives you confidence that we can't get up that far at a time when there are many signs of very sticky inflation?
Yeah, I think you are starting to see some signs, Lisa, maybe not of prices rolling over so much, but of the demand side starting to push back a little bit on these high prices, right? Whether it's used cars or new cars or housing or food or energy or airfares or lodging, you're starting to see a sense that consumers have probably had enough and are getting to their limit of the price increases they can take, right? I mean, you've seen mortgage refinancings and mortgage activity plummet in the face of these higher mortgage rates. And that's obviously a very interest rate sensitive sector. And I think you're already starting to see a reaction function from the consumer. So maybe that's the delta you're seeing. So the funds rate, I've always thought the range on the funds rate is probably going to be between 0 and 3 for the rest of our lives. And maybe 1.5 is neutral. So if they get to 3, I think that's really tight policy, and I think that's going to slow demand pretty sharply.
Subadra, do you agree?
Absolutely. I think the story from here on is going to be the consumer and what happens to demand and demand destruction. You're seeing a very sharp rise in gas prices, from $3 earlier on this year to 4.5 on average in the country. So you're going to see demand destruction from higher commodity prices, higher food prices, and like Brian was saying, it's a lot more about just it's broad-based, but it's also a lot more of headline inflation that the consumer has to deal with. And wages are rising, but they're not rising as fast as the cost that the consumer has to bear on headline inflation. So demand destruction is really going to be the key. The other sort of metric that we'll be tracking closely is consumer sentiment. Michigan survey, we had a very sharp correction in consumer sentiment. So I think ultimately that retail sales, those are going to be sort of the leading indicators of how far the Fed can go on the policy front. Because once you start seeing a retrenchment and demand destruction coming from the consumer, it's going to make it very hard for the Fed to continue to raise rates under those circumstances.
But Michael, this has been one of the conundrums, right? That we've seen consumer sentiment, at least as measured by the University of Michigan, deteriorate to the weakest since 2011. And yet people are still buying. They say, we don't feel so good, but we'll just go shop and make ourselves feel better. At what point are we starting to see that? And how much are you looking for signs of that pushback from consumers and some of the earnings reports that we started getting out today?
I think we were seeing it in other parts of the world first, right? Where inflation has been actually a bigger problem. Europe obviously is seeing a pretty decent slowdown. China, the emerging markets, right, are really seeing a big challenge in the face of higher food prices. I mean, they either can't afford to pay them or they can't even find the food, right? So there are real problems starting to bubble up from around the world, and it's difficult for the U.S. to kind of be isolated in its strength here. But I still think that you're getting to a point where inflation is becoming much more of a problem than it is a tailwind.
Brian, Michael raises a really good point. This question of the haven trade at a time when inflation is hurting a lot of the developing world, well more than the United States, which has a great degree of dynamism still in the economic momentum. Have you ratcheted back certain emerging markets bets at this point? Is that where you're focusing sort of your move away from, rather, and seeking haven in certain assets in the U.S.?
Certainly that's been the trade of the year, right? I think people came into this year liking emerging markets, then obviously hasn't worked out tremendously well. But I think a lot of it's in the price now. So actually we're starting to go the other way, right? If you look at, U.S. high yield, say, versus emerging market credit, or even versus European high yield, there's opportunities to go the other way. You have to be selective. As Michael said, there's problems out there, and those problems could get worse. But I actually think the U.S. as a safe haven trade has probably come close to running its course.
Okay, so Brian, where would you go?
Listen, I think there's opportunities in credit in emerging markets, right? A couple hundred basis points wider, higher yields than you get in the U.S. If you look at emerging markets broadly, right? They've hiked rates. They've actually been fighting inflation, I think, more actively than the Fed. So I do think they're ahead of the curve. So we continue to actually like to find places in emerging markets that we can buy. We continue to like bank loans, right, where you actually have no duration. That trade has done very, very well. That's more of a U.S. and European-centric asset. But there are plenty of places you can hide that are not kind of the generic U.S. names that I think have done well because of the circumstances that we've been describing.
Subadra, what's been a haven trade for you?
Well, it's really hard to hide anywhere, given the fact that all global bond yields have risen quite dramatically. Ultimately, I think that it's we've the other haven currencies haven't really worked out well either. Like you're starting to see, the yen start to weaken. So in some respects, it's ultimately the dollar as well as gold and treasuries. When the market starts to settle down a little bit, I think you're going to see that demand come back into the treasury market after this very fast run up in yields. But
Wait,
it's been
hold on
tough.
a second.
It's been really hard.
Where in the treasury curve would you be buying?
That's a good question. I would say that ultimately it's going to have to be in the long end because the curve is still, has steepened out a bit. I think that the trajectory over the next several months is going to be for the curve to continue to flatten as the Fed gradually tightens monetary policy. So I'm still kind of a little bit more skittish on the front end because you could see that overshoot towards 3% in 2-year yields as we start repricing a much higher terminal Fed funds rate. But the curve is going to, I think over the next several months, continue to flatten. So I would still prefer the long end versus the short end.
Mike, what about you? What's your haven at this point?
Yeah, well, it's interesting on the Treasury curve, firstly, so then I'll make a comment on emerging markets, right? The curve is really flat until you get out to that 20 and 30-year point, and then it jumps up. So there's a relative value trading opportunity to buy those kind of on a hedged basis because they're just really structurally undervalued. But generally, when the curve gets really flat, right, the knee-jerk reaction, especially among retail investors, is to buy the lowest risk or shortest maturity bond with the same yield. So why would you own a 10-year yield when you can buy a 2-year at the same yield, right? But actually the right thing to do is to go out in duration. Kind of that 5 to 7 to 10-year part of the curve is the one that does the best once you get a flat curve, because the next big move in the curve, even though, the curve will probably continue to flatten here in the near term, but the next big move over the next 3 years is a big bull steepener, right? When the Fed realizes, oh my God, we've gone too far and they have to cut rates. That's when you get all, the bang for your buck by being more in that intermediate part of the curve.
Yeah. Interesting, that idea on betting on rate cuts later on. Subadra, Rajappa, Michael Collins, and Brian Weinstein, you're all sticking with us as we hash through some of the credit story that we have seen, which is up next on the auction block. Junk bond issuers remaining on the sideline for the most part, with investors turning more cautious. That conversation coming up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for the auction block, where we kick things off over in Europe with the first foreign FX sovereign bond sale since Russia invaded Ukraine. Croatia's successful offering pushing weekly volume above 7 billion euros. In the U.S., high-grade bond sales hitting $17 billion, meeting weekly estimates. A large deal of this was Amazon's 7-part jumbo deal. And the junk bond market remaining on hold. Banks struggling to sell the only high-yield offering of the week, with investors getting increasingly selective. Still with us, we are so lucky to have Subadra, Rajappa, Michael Collins, and Brian Weinstein. There's an issue with respect to the Amazon deal. I was looking at it and I was wondering, why are they raising money right now? Brian, is this a good time for companies to lock in financing costs because they're only going to rise from here?
I mean, I guess that's the theory, right? It is funny to look at the issuance coming at basically the highs in yield, but I think it's a good reminder that for a company like Amazon and others, that the growth rate they're looking at is probably still a pretty good rate to borrow at. Listen, I think if you're a company, you can't take the risk, right? You issue when you can. You can always find ways to refinance it or buy your debt back if you need to. So it is. I was thinking the same thing when they issued. I wish they'd done it 6 weeks ago. But I think at the end of the day, the extra 100 basis points for Amazon probably not the biggest concern.
But Brian, this is really a great test case, because does Amazon need the money, right? I mean, honestly, for an opportunistic bond sale that possibly could go toward financing share buybacks, what could the thinking possibly be other than they just see yields going higher?
Yeah, listen, I think my favorite question people ask me is, should I refinance my mortgage? Not so good right now, but the answer is always yes, right? As rates fall, if you're wrong and rates fall more, you can do it. But if the rates go higher, you can't go backwards in time. So borrow the money if you're Amazon, if you know you're growing, and you can use that money for buybacks or anything productive. Because if you're wrong and rates are 375 next month, man, that's eventually it gets expensive to be wrong.
Okay, so Michael, what's your take on this? Because this logic would seem to make sense if any companies actually needed money, but they've been borrowing like maniacs over the past 3 years. So who's left to need money, or do you see issuance just falling off a cliff?
Yeah, I mean, what you're seeing is you're seeing capital investment start to pick up again a little bit, right? Not only in the energy and commodity space, but in general, as companies run out of employees, they need to rely more on technology and robotics. So you are seeing a little bit of an uptick in CapEx that could be funded by debt. But you're also seeing a huge reliance on the debt markets to refinance all of the debt that has been issued over the last decades. I mean, you're going to see a lot of that activity regularly. Amazon doesn't fall into that. But the other point about Amazon, Lisa, I mean, credit spreads, in the investment grade corporate market went from 80 to 140, then back down to 115. So a lot of these companies, they do hedge the interest rate risk, and they're looking at the spreads, and spreads had come in a lot. So maybe from a spread perspective, they are being opportunistic and try to access the market before spreads widen. And we're in the view that spreads are probably poised to widen a little bit rather than tighten from here.
So that seems like you wouldn't necessarily be buying at this point.
Yeah, we actually used that last rally we've had over the last couple of weeks in credit spreads, both in high yield and investment grade, and even in emerging markets to some extent, to sell into that strength. And sure enough, I mean, spreads are starting to bounce a little bit wider here again.
Okay, so Subadra, there are dueling issues here. There's the point about the fact that fewer companies may be selling debt at this point because it's not as cheap as it used to be, and they already sold so much debt they don't really have to, and they weren't necessarily getting cheaper rates. But on the flip side, you are seeing signs of consumers starting to push back and not perhaps buying as robustly as they once did, which will be a credit negative eventually. Which is the main driver of your thesis?
So I think that, I agree with Michael. Eventually, you are going to start seeing spreads start to widen as the Fed raises rates. But for now, you look at, corporates and balance sheets and corporate profit margins, they're still pretty healthy. There's really no serious risk of default or any sort of concerns for corporate bond investors. That could eventually come down the line, but it's not a concern for now. There's still a lot of cash to put to work, and you want to put your cash to work where you're getting your best returns, and that's in the corporate bond market, broadly speaking. So I think this demand dynamic is pretty much going to be here to stay, at least earlier on in the cycle. And, like Michael was pointing out, the spreads have narrowed. So a lot of that has to do with demand. And, at least over the next, few months, you're going to see that sort of dynamic till you get towards the, I'd say, latter half of the cycle, which is when you're going to see spreads start to widen.
Mike, just real quick here. There's been an 11% sell-off in investment grade credit so far this year. Why aren't we calling this a taper tantrum?
Yeah, I mean, it's all due to rates, right? Like I said, credit spreads have been kind of range bound. They're a little bit wider than they were at the beginning of the year, but it's really the rate story, right? And I think it's just a total repricing of expectations for inflation. Right? Inflation expectations have gone up a little bit, and the funds rate, the terminal funds rate. So that's really what's driving it. The corporate market is a longer duration index than like the high yield market or the bank loan market for sure. So that's where you've seen the brunt of the pain. The longer duration assets, not surprisingly, including some tech stocks, have done the worst here. So I wouldn't call it a taper tantrum. I actually think once the Fed starts really ratcheting down their balance sheet in an effort to slow growth and control inflation, as you know, we think that probably signals more of a peak in rates than a reason for them to sell off more.
Well, all of you are staying with us, Subadra Rajappa, Mike Collins, and Brian Weinstein. Still ahead, the final spread the week ahead, featuring a host of central bankers, including Chair Powell and President Lagarde of the ECB. That conversation coming up next. This is Bloomberg. This is Bloomberg Real Yield. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for the final spread. The week ahead, coming up, Bank of America rounding up bank earnings on Monday. Plus, we get U.S. and China PMIs, the Beige Book on Wednesday, plus Fed speak from Bullard, Evans, and Daly throughout the week. And finally, Chair Powell and ECB President Christine Lagarde speaking on Thursday. Still with us, especially ahead of that ECB meeting, Subadra, Rajappa, Michael Collins, and Brian Weinstein. Brian, what's your sense of how much pressure the ECB is under, especially when the market is pricing in already several rate hikes this year? Do you think the market's gotten ahead of itself?
Yeah, the ECB is under some pressure here. You can see it in some of the things they've said about, they have a facility to bail out, peripheral spreads if they widen. And obviously you have weak countries, strong countries, and the inflation kind of in their backyard with the energy prices and pipelines and all the geopolitical risks. So I think the market's probably ahead of itself on the ECB, although the pendulum does seem to have swung back towards the more, Bundesbank style fight inflation, don't let this get out of control than I thought it would. So maybe it's priced correctly. But I do think it's harder for the ECB to get this one right. The Fed has a very difficult job, and the ECB's may be that much harder.
We're running out of time, and I don't want to miss my favorite part of this particular show, which is the rapid fire round. So we're going to start with the three questions and the three quick answers. And the first one is, will this cycle's terminal Fed rate be closer to 2% or closer to 4%? Subadra.
2%.
Mike.
2.
Brian.
2.
Wow. What's better value right now, investment grade or high yield corporate bonds? Brian.
Investment grade.
Mike.
High yield.
Subadra.
Probably high yield.
What's worse, to be long German or to be long U.S. 2-year bonds? Mike.
Probably U.S. I mean, there's a lot of hikes priced in that German curve, and that will probably not happen.
Brian.
I'm going to go German.
Subadra.
German.
All right. My thank you to all of you. And I want to elaborate on all of that, which we will do at a later time. Subadra Rajappa, Michael Collins, and Brian Weinstein. Real Yield returning next week at its usual day and time, which is 1 p.m. Friday, with Jonathan Ferro from New York. That does it from us. This was Bloomberg Real Yield. This is Bloomberg.